Well, good morning, everybody, and thanks, David, and thanks, LSEG, for inviting us to be part of today's event. It's great to be here again for a London Climate Action Week. I'm going to do a brief introduction to the panel. We have Michela Baraletti from Phoenix Group, Liz Fernando, CIO of Nest, and Peter Backer from the WBCSD. I'm going to do a very brief introduction, some background to why transition is important, I think, and then we'll get into the questions for the panel. I think it's important to realise that climate change has not just been an investment issue for pension funds for the last 5 or 10 years. I think the first work that I was involved in on climate change and how it's an impact issue for pension funds was in the early noughties, when Liz and I were working for a pension fund, and we did a long report on why climate change was an investment issue that needed to be taken into account by pension funds. That led to the Institutional Investors Group being established and its equivalents in different markets around the world, the US, Australia, Asia. What I would say is, yes, it was seen as an issue then, but not a huge amount really happened to address it. It wasn't really taken seriously by investment institutions until the COP in Paris, when I think climate change really hit the political agenda, the social agenda, the investor agenda. And following on from that, we saw a lot more activity from asset owners, asset managers, and indeed corporates in terms of addressing it. A big thing was setting net zero targets for pension funds and asset managers. What I would say is those targets were very focused on decarbonisation. Pension fund is here with its carbon emissions and the carbon footprint. We need to get here, net zero by 2050, Paris alignment by 2050. And we've seen a lot of activity around achieving that. And in fact, I was talking to a large UK pension fund a couple of weeks ago, and they haven't just hit their 2025 target, they've hit their 2030 target as well in terms of decarbonisation. The problem with that is that actually decarbonising your portfolio is a relatively easy thing to do. You just sell the carbon-heavy stuff. The problem is all that does is take it out of your portfolio and put it into someone else's portfolio. And that's why the transition is important. That's why we have the focus on this today. And that's why the TPI was originally established, to provide investors with information around what companies were doing to manage their transition, and management quality assessment, and how they were setting targets against sector-specific pathways to actually get from where they are now to where we need to be in 30 years, 25 years time now. And Professor Simon Dietz, who's on the next panel, will go into a bit more detail about what the TPI does. But what I would say is it's a widely used set of data. It's now used by about $100 billion worth of asset owner funds that use it to track TPI data run by FTSE Russell indices. It's used by investors in the stewardship activities, the integrated investment decisions, their voting activities. So that focus on transition away from just focusing on decarbonisation in portfolio has been a really important development over the last 5 or 10 years, I would say. Now getting on to the really important part, which is the questions for our panel. And firstly, starting with Michela. Phoenix Group is probably the largest UK asset owner with about 13 million clients and around £300 million worth of assets. How do you see climate change as an issue that affects your investments and the strategies you have in place?
Thank you. So as you said, we serve almost 12 million customers, and we have 290 billion assets under management. Customers stay with us for quite a long time. Therefore, we have capital to invest for a very long period of time. So you can't do that without taking into consideration what climate risk can do on the resilience of your portfolio. Climate risk, as you mentioned, has been mentioned before also in the previous panel. Climate risk is financial risk now. It's no longer like something that you can put on the back and check the box exercise in the sense that you are ESG compliant. No, you need to consider what does it mean for the valuation of the assets on your portfolio, for the creditworthiness of the asset on your portfolio, and finally for the resilience of a portfolio overall. we are very committed. We integrate climate risk in all our investment process, starting from the strategic asset allocation, but also in the engagement with our external asset manager, because ultimately, we work with partners that, despite may have withdrawn from some of the initiatives, still remain very much engaged with us to ensure that we continue on our decarbonisation path. We have published a transition plan in 2023. It was our first one, and we are planning to update it every 3 years, as should be the best practice from the TPI. In order to provide an update on our 2025 and 2023 targets, and also how we are going to do on the longer term. I think we are also very committed in supporting transition finance, so supporting the transition in the sense that, as David mentioned, it's not just about decarbonising the portfolio, but it's really about supporting the economy in terms of decarbonising and supporting the companies in getting into the journey of their net zero. And also to do that from an investment perspective, I think data will remain very important in order to ensure that you can analyze how ready a company is, or their readiness in terms of meeting the low carbon emission, but also in terms of standardizing the disclosure, also for investors to understand how, as the asset owner, you're managing the portfolios.
Great. And I'm delighted to say that Phoenix are a strong supporter of TPI, and in fact are one of our board members. Can you explain how you use TPI data and analysis in your investment processes?
So first and foremost, we are very proud of being part of the TPI. I think we've been on the board since 2023, but we are also participate to the strategic strategy committee, strategy advisory committee, in order to really being able to participate and support TPI in developing methodologies and frameworks that we can then implement ourselves. In terms of how we use the TPI data, there's multiple ways that you can use TPI data. I'm probably going to start with stewardship, in the sense that the data that have been provided by TPI can be used to ultimately inform your strategy on how, and your priorities on how you're going to engage with company. The SDA1 methodology can also provide you really example of best in class that can support you in also engaging with your target company in the climate change discussion. And of course, TPI for us, the data are essential in terms of benchmarking the performance of our sustainable multi-asset funds. So we have 8 funds that receive the SDR label under the FCA SDR labeling. Those are our default workflow pension scheme under Standard Life, the standard offering for sustainability, and we are able to track that thanks to the data from TPI and developing a FTSE index to support the tracking of how the funds are performing. And finally, I think being part of the TPI provides you an opportunity to share and collaborate with other people in the industry in terms of taking this forward.
Great, thank you. Liz, just so people know, Liz used to be my boss, so this is an odd situation for me. You work for Nest, you're Chief Investment Officer for Nest, the auto-enrollment, one of the auto-enrollment platforms for the UK, but growing hugely. Again, I think you've got 13 million members as well, and your assets are growing so quickly, you're likely to be the largest pension fund in the UK within a few years. You're also very focused on how climate change is impacting your assets and your future investments. Can you give us the rationale for why you're doing that and how climate change is built into your investment strategies?
Yeah, so it's not dissimilar to what Michaela was saying, in that our youngest member is 19 years old. Retirement age by the time they get there will be north of 67. And we hope that they will have a long and enjoyable retirement. So our job is to generate the best investment returns we can for them over that period where they're accumulating their savings pots. And we think part of doing that is to take account of systemic risks, of which climate change is one, We don't think financial markets are still very good at pricing long horizon risks such as climate factors, and that's why we deliberately embed it in our pre-retirement solutions to try and make sure that we're ahead of that curve, because we think people will ultimately wake up to it. We are seeing more physical risks as the world is warming. We know that physical risks will go up as the world gets warmer, and physical risks impose costs on businesses in terms of supply chain disruption, in terms of customer not being able to do business because their operations might be out of action. And so thinking about all of those things and embedding that into the strategy makes sense. We also think that there's no point saving for retirement if you don't have a decent world to retire into. And again, because of physical climate risks, we know that leads to higher insurance costs, higher housing costs. Typically our members are low to moderate incomes earners, so they are more vulnerable to those sorts of risks. And therefore we think it is incumbent to think about this post-retirement as well, and to try and make sure that they not only have a high-quality, sustainable wage in retirement, but this is a decent world that they want to be able to retire into.
Great, thank you. And Nest is largely, if not totally, externally managed. Michaela indicated in her response to the question that there are some changes in the way that some asset managers are approaching climate change. We can't move away from the fact that geopolitics has been such over the last couple of years that there has been quite a lot of pressure on investors who are looking at climate change in certain markets around the world. How do you assess how your external managers are dealing with climate change in alignment with your beliefs, and how have you dealt with the fact that some have definitely changed their positions, you put it politely, on the issue?
Yeah, so there's multiple strands to that. So up front, we have a commitment to net zero in 2050 aligned with the UK government's targets, and we expect our asset managers to be aligned to those and to be driving their portfolios in that direction as well. Part of our manager selection process focuses very heavily on how embedded integration of climate risk and other factors are into the decision-making process. Also, the opportunities that arise from climate. It's not all downsides. So it's an upfront part of the hiring process. We then, once they're on board, we set targets, not only in terms of the decarbonisation journey that we would like to see, but also other targets for stewardship and engagement and those other broader factors that need to support all of that. And we hold them to account for it. It is certainly true that the environment, particularly in the US, means that firms are less willing to be noisy about their commitment to these activities. That's definitely a double-edged sword. I think it is uncovering those who perhaps didn't believe it, is intrinsically in their DNA as others. We aren't going to force our asset managers to be publicly noisy about what they're doing, having them in courtrooms, having them defending themselves in front of the SEC, massively distracting, not good for business, I would suggest. And so we are being more understanding where companies don't want to be as public on their commitments, but we do want to see them continuing to work on the implementation within our portfolio, and we do not want to see them doing things in the wider organisation that undermine what they are doing in our portfolio. And so that really is how we try and address this more holistically. A number of firms who have withdrawn from the collaborative initiatives have committed that they are going to increase their internal resource as compensation for that. So we will be watching and seeing if that genuinely happens and if those teams can make a difference.
And what happens if not?
That's a very interesting question. And so far, all of our managers are are doing what they say on the tin, but it is early days. I think where I am slightly nervous about the reduction in collaboration is I think it just makes life really hard for corporates, because they are, instead of having one or two voices which aren't completely united, but at least they're singing broadly the same tune, if instead they're being bombarded by 100, 1,000 different voices, it makes their life really difficult. I'm also part of the Investor and Issuer Forum, which is a group which tries to get together asset owners, asset managers, and corporates to talk about some of the grit in the system. We had a meeting last week, and this was a hot topic. The fragmentation of the voices makes life difficult for them to know, who they should be listening to.
Yeah, but probably just to add quickly, in the sense that I don't think there's an immediate read across to what happened in the asset manager side of things in terms of being publicly part of an initiative or not, to what the asset owner are trying to do. My main concern, though, is that we can decarbonize as fast as any underlying investment decarbonize. So at the moment in which, as you said, we can decarbonize by just passing on the carbon intense investment to someone else, but then you don't meet the net zero transition. So if I think about what's happening now, I'm more concerned about companies taking a step back in terms of how rapidly they will decarbonize, making the life of asset owner and asset manager more complicated, despite you sympathize with them. It's a very difficult world to navigate. So,
yeah, I mean, from the investment manager perspective, the asset manager perspective, you can understand the pressure they've been under in certain markets has been horrendous. What I've not seen is many asset owners going backwards on what the commitments they've made. There have been one or two, and there have been reasons why they've done that. But in general, I think asset owners are maintaining their commitments and ambitions to achieve net zero, and have the processes in place to do that. But moving on to companies, because there was a nice segue there and some of the answers. WBCSD has 200 company members around the world who take a leading approach to addressing sustainability. Last year, you worked with LSEG, PRI, and the Sustainable Stock Exchange initiative to call for disclosure around transition plans. Many people won't initially get the idea of why should companies be calling for mandatory disclosure. Why do you think they should be?
Yeah, so it's first and foremost great to be here and to see that today you're bringing investors and corporates together in the house of capitalism. This is where we need to be, because my view is very simple. If we want to crack sustainability, climate action, we need to align the financial market and the corporate world, and they are not aligned today, despite all the initiatives and acronyms that we all float around. The corporate world is relatively straightforward. We are moving quickly out of making promises, we call them commitments or targets, into what are the strategies that will actually make this transition happen. And we understand that corporates need to manage performance, needs to then disclose that performance to the capital market in a decision-useful way. And then we expect capital markets, financial markets, to price those performances in valuation and allocation models. That's what needs to change, and that's where we are misaligned at the moment. So from this point of view, a transition plan, in my mind, is nothing else as a corporate strategy. How will you keep your company successful in the future? And building on what Liz said, I really want to caution the conversation. I heard it on the television just before. This is no longer about long-term risks. Climate risks are here and now. $12 billion company in beverage industry, $1.5 billion EBITDA, has mapped all locations in the world where they grow commodities to make wine, whiskey, etc. Weather models, climate models, millions of scenarios. What would happen if there is too little water, too much water, too little heat, too much heat? In all cases, yield of products come down, commodity prices go up, P&L comes down. Base case scenario, 1.5 billion EBITDA gone in 5 years. That's climate risk now. Insurance costs will go up, assets will become uninsurable. We need action plans. We don't need more promises for 2050. We need to be on the case now. That's the conversation you need to have with your investors. That's asset owners, asset managers need to think about in their portfolios. And so transition plans are the language, are the corporate strategies that will make these transition happen. And then disclosure frameworks like ISSB will show whether you're actually delivering what your transition plan said. Are you making the capex? One last thing, there is this perception that business is backtracking. My job here this week is to say that's not true. All of us here, myself included, we're way too focused on what's happening in the US of A. And it's not helping, let's be clear. But if you go to Asia, there's none of that. In Asia, people understand this is about competitiveness, about the economy of tomorrow. Europe is kind of in the middle, trying to figure it out. But there's a lot of positive momentum. We launched the Business Barometer this week. 300 top executives from around the world, asked them, what is your progress? What do you see in terms of net zero transition? 91% came with the answer, we are investing the same or more in the transition than we did a year ago. No change, no backtrack. 61% says climate risk is already in our P&L now. 94% say inaction is more expensive than action. We see now really the momentum is still there, but we need to get the alignment with the financial markets sorted out. And all the plumbing, the building blocks are there. But the last thing I'll say, and then we have to be very careful to continue to push for compliance. Companies that we work with are all saying the same thing. CSRD, yeah, we understand we need to fill the form. We have put 80% of our sustainability teams on getting that done, and they're not doing the transition work. So we really need to, we do this to get companies to make better decisions, to provide data that allows investors to make their side of better decisions. It's not about filling forms or ticking boxes.
Yeah, and just to pick up on your focus on Asia, I was at Ecosperity last month, which is organised by Temasek in Singapore, which is basically Singapore Climate Action Week. And there were investors from all over the region and all over the world there, and it was very positive. The investors there, the companies there, the policymakers there were very much pushing towards, this is an issue that we need to address. Let's not take much notice of what's happening further west from here, but let's focus very much on what we need to do to manage our exposure to a changing climate, and not only the need to transition, but also the physical risk. I'd pick up on one point you said, that companies weren't backtracking. I think a lot of commitments were made at COP26 in Glasgow, and I would argue that there has definitely been some backtracking by some companies around those commitments. How are you seeing your membership and the broader corporate community maintaining what they were doing, or if they are backtracking, what's the reasoning behind it?
No, I think the thing we all need to realize, I mean, when COP26 in Glasgow happened, you would be the hero by making the biggest promise, the fastest to be net zero, whatever the game was in those days. It was very useful, by the way, in those days, because it drove the mindset in business like, oh, wow, this top person finds this important, let's go figure out. The thing we must all be very careful about, it's very easy to say, I'm here today, I want to be net zero in 2050, whatever the date may be. It's incredibly hard to make that transition happen. Look at the automotive sector. It's the simplest example. Stop combustion engines, go electric vehicle. Nobody will argue. But then you look at it, wow, it's pretty difficult to retrain 4,000 engineers that know everything about efficient ICE to start building EVs, but you can sort it out. That companies are there to do that. But then you need charging infrastructure, you need renewable energy to charge these vehicles. You need the insurance companies to not put higher premiums on electrics than on combustion engines. You need to convince consumers that range anxiety is no longer a thing. There's a system change that you need to do, that an individual company can contribute to, but not do on their own. So these transitions are not linear. They're very bumpy, and depending on the economic, the tariffs, whatever else is going on in the world, these are processes that you need to have a dialogue with your investors. I would argue similarly with your policymakers, that just setting a target in 2035 to ban something, when the transition there is going to be bumpy, it needs to be co-designed processes. Transition plans are super important because they show this is how I think I will implement the transition. And then on an annual basis, you can have a conversation with your shareholders saying, oops, yeah, this works, this doesn't work, this is what we're trying to do to correct, this is what other people need to do. And then the decision useful information for an investor is then in their hands and they can compare it. And that's why it needs to be mandatory, because the rule is, I've been a CEO for a long time. If it's not comparable, if it's not materiality based, then what are you going to do? And that's basically where you still are today. What are you going to do with all that data? And so that's why this is so important.
Yeah, and we'll get back to the mandatory point in a moment. I think the same is true in terms of being able to explain to your shareholders, but the same is true for asset owners and asset managers. I think the challenge that the sector has is it's made these decarbonisation commitments, and it has to be seen to be getting to where it needs to. As I said before, that doesn't necessarily make real world impact. So if you're looking at companies that are transitioning, you may be investing in the cement company that gives you a hit on your carbon footprint, should we say. So you're not necessarily aligned with the target you need to achieve. But you need to be able to say, but we're in this particular cement company or this steel company because they're the ones who have the transition plans that will, in the future, mean that we will be aligned because we're still going to need cement and we're still going to need steel in the future. So those companies have to transition. Moving on to Michaela and Liz, the same question for both of you. We've just heard that reporting is important. We heard from the first session how ISSB is supporting that on transition plans as well. Do you think there should be mandatory reporting of how companies are transitioning?
Can I start by saying that I don't think anyone in this room would like to be mandatory to do anything, generally speaking, in the sense that you would like to have the ability to decide. I don't think anyone likes to be told by the government or the regulator what to do in terms of managing their business, so I'm probably a bit critical here, but when I see mandatory, I say, well, it's always a bit difficult, right, and challenging. Said that, unfortunately, you need some kind of framework that bring consistency and transparency across, to your point, so that you can compare and understand transition plan by various companies if they are held to the same type of standard or the same type of disclosure. I think voluntary has been very helpful, but then you're kind of in a minefield on how you compare and contrast. And I think there was mentioning either before or at the TV about, when you look at financials, well, they are all standardized. So you can compare anything across any sector and understand the differences and come up with your own assessment of creditworthiness. I think from a transition and net zero plan, it's a lot more challenging to be able to hold them accountable to the same type of standard. So I think disclosure and standardization, it would be extremely helpful for us to be able to implement a net zero transition in a credible way, but also in a consistent way. And I think transition actually help us also to understand how we are supporting the company. And on your point about, forget about the West for a second. Unfortunately, in the asset owner world and in pension funds, I'm sure everyone in the room is trying to understand how to look at asset allocation and how to become less dependent on the US. But the US is the biggest equity market and the business fixed income market in the world. To build an alternative to that is not something that's going to happen in the next 4 years. So unfortunately, we are all, a bit struggling with the same thing in the sense that everyone sees that this is a great opportunity for Europe. We look at Asia as well, but Europe again, it's very fragmented. When you invest in Europe, whether private or public, it's like they have different stock exchanges. They have different regulatory framework. They have different insolvency regime, and that makes it particularly difficult. So I agree that we should not just look at the US. Of course, they have their own challenges in managing what's happening from a geopolitical risk perspective, but it's the big elephant in the room. We cannot divest from the US. And as you said, it's like you're ultimately, it's true that climate risk is here today, but in some cases, the impact may be on a longer scale. And asset manager and asset owner look at performance on a daily basis, hopefully not, but to have to tell your customer that you are underperforming benchmarks, it's a very tough conversation to have, despite you may have done the right decision in terms of the longer term. And then it probably opens up the questions of what are the right benchmark, because ultimately, even in a passive equity funds, if you kind of track one index like the S&P 500, you're actually taking a view that you like tech because of the composition. So probably it's a longer journey also to understand what are the right benchmark that we can use in order to measure performance.
Yeah, I think I'd come back to a couple of points. One, that transition pathways give us the forward look and an indication of where companies are going, and markets are forward looking. They discount information of what's going to happen or we expect to happen in the future. So to the extent that we can have some visibility and some standardization on how companies are planning for the future, and I think Peter's absolutely right that transition plans really shouldn't be anything more than corporate strategy. They should be one and the same thing. If you are planning for your business to be around in 50 years or 70 years, this is going to have to be part of how you do business. Giving us metrics that we can hold people to account to, we can track the progress, really helpful. I think it was very easy and fashionable to come out with some aggressive targets. The lack of credibility as to how those are actually going to be implemented in the real world, and it is hard, I think was a problem. And I think that's why a number of companies have had to say, whoa, actually, you know what, that's going to be a bit tougher than we thought, and it's going to take a bit longer. But we're still making those strides. The second point I would come to is that yes, we're a UK-based fund. Our members are all, by definition, UK workers, UK retirees, but we invest globally. And it is deeply unhelpful to corporates, and we had this from the earlier panel, to have disparate standards in different places. The complexity and the time that gets lost to meeting these different requirements is just unhelpful to everyone. It's unhelpful to the asset owners because you can't do direct apples-to-apples comparisons. It's complicated for the corporates. Legal teams get excited because they don't want to say, sometimes these regimes are even conflictory. So by complying with one, you're in contravention of another one. It gets very messy very quickly. So the sooner we can get to some global standards and some global agreements on this, I think the better. Because it will just make everything smoother. And I come back to a lot of what we are trying to achieve here and what will help us all in achieving the real world outcome, which is ultimately what matters, is getting rid of the friction and the bits of grit that get in the way of people doing the right thing. And so the sooner we can drive towards that, frankly, the better.
Yeah, I think most people in the room are probably supportive of ISSB standards being adopted in different markets around the world. A slightly different question for you two as well is, and bearing in mind that in the UK, asset owners and asset managers have to report to TCFD on climate change already, should asset owners and asset managers be required to have transition plans in place as well?
I think ultimately, if you as a fund have got a target to be net zero or to shift your portfolios in different directions, if we expect that of the corporates, I don't think it's unreasonable that we should have a similar plan that we can be held to account for as to how we're going to turn those nice statements into reality and have that change. But I think we need to be very careful that it would be very easy to make your portfolio look pretty but not to have real world outcome. And so the sequencing of all of this is very important. We need the regulators, the standard setters, the policy makers to put in place clear requirements and consistent requirements that align to their stated public objectives. We then need the corporates doing their bit. We need the asset managers because we depend on them to implement our investment strategy, to do their bit, and then we come at the end of that chain. Sometimes it is felt that the asset owners have been asked to be at the front of that queue. So TCFD reporting being absolute case in point, we were asked to do our TCFD reports before our asset managers were obliged to give us that information. It doesn't work. So yes, supportive, but we need the sequencing right.
Asked is polite. We were made to do them.
No, it's similar in the sense that we have published our transition to net zero. So we have a net zero transition target of zero by 2050. We published our first transition plan in 2023 with, again, short-term, medium and long-term target. We are working to refresh it, so we plan to publish a refresh of our transition plan in 2026 to provide updates on how we are doing against our 2025 target, but also how we are looking at 2030 and beyond. And this focusing is not just about decarbonizing the portfolio, but again, it goes back to financing the transitions. And I agree with Liz, is like if we expect corporate to be on a transition to net zero, why should financial allocator or financial service not be held to the same standard?
And Peter, the ISSB standard requires that companies disclose transition plans if they have one. Should that be they should disclose they should have one and they should disclose it?
Yeah, absolutely. There's not even a question in my mind. And I'm not scared of the word mandatory. Last I checked, financial reporting is mandatory. I mean, this is just the same. It's the same thing. We shouldn't treat it as a different thing. And to the point, I don't know if financial institutions need a transition plan. I mean, it's not my space. But what I do hear from every CEO we work with, there's currently no economic incentive coming from the financial institutions to go hard on climate action. If a company is much better at dealing with climate risk or creating climate opportunities, why doesn't it have a lower cost of capital? So the conversation we need to have between corporates and financial institutions is, how will you price in either risks or opportunities? And ISSB disclosure should be an absolute mandatory global baseline, because then we in one blow go to comparable materiality-based data points that hopefully are decision useful. But the second conversation is, in your valuation models, in your capital allocation models, what is the language so that as a company says, okay, I'm going to put more money, more capex into the decarbonized strategy, how will that be reflected in my whatever it is, buy, hold or sell? That's the conversation we need, and that's no different than my financial performance.
I hear a challenge there.
I was actually thinking because I think one of the challenges some companies have faced is that they, and it's not a dissimilar problem to R&D investment, when you're doing innovative edge type thinking, the R&D investment involved, that the payback you get from that can come several years or decades down the line. And so I think this is where corporates really need to work with us on helping us to understand what those paybacks are likely to be, how we can get confidence in those over time being real rather than hoped for. And that way we should start seeing people reacting to that, because if you can see a future profit stream coming or a cost avoided, then that should be reflected in the share price today.
So the thing we will be launching in New York Climate Week in 2 months, I think, is the CEO Guide to Physical Risk Assessment in the Supply Chain. That's going to be the breakthrough conversation to have, because most companies will have a view of their assets, whether or not they're exposed. Almost no company has the view on their supply chain. That assessment needs to become an integral part of an enterprise risk management system. That needs to become part of the conversation with the investor world. And then indeed, like you say, okay, well, here's my assessment. These are the potential costs, or these are the mitigation opportunities I see. And then you'll have again a conversation that makes it real.
Great, thank you. And just
from a pricing perspective, sort of being here, David advocate a bit, but in today's day and age, it's actually quite challenging to see how markets is pricing any risk, let alone climate risk. And it's I think it's a very challenging to navigate. At least I do mainly credit for a living and on the fixed income side of things, and understanding how all the risks that are out there, including climate, are priced in, because I don't even see credit risk being priced appropriately, or maybe I'm wrong and I'm missing something, and the world is fantastic.
I don't think so.
Thank you. And I think the important thing is that companies and investors need to be talking about this more. On a slight sales pitch, there's a WBCSD and a TPI session this afternoon where companies and investors will be talking to each other with our colleagues from the TPI Centre at the London School of Economics. Can we thank Liz, Michaela and Peter for making